Peter, it's great to see you.
Yeah. You know, first of all, I don't want to go broke. I don't care if it's in an orderly manner. Right? So if you're telling me the dollar is going to lose value, but don't worry, it's orderly, I'm not going to stick around for it. I'm going to buy gold. I'm going to buy euros, Swiss francs, Singapore dollars, Australian dollars. I'm going to get out of Dodge. I'm not going to stay here and get shot.
In terms of the dollar falling to uncharted territory, which is what you say, what does that mean exactly? What sort of levels are we talking about?
Look, I don't know. It's a bottomless pit. You know, normally when we've had these meetings of the G7, G8, now G20, when the dollar is making a record low, which it's doing, normally the talk is we're going to prop up the dollar, we're going to have coordinated intervention. Now the talk is let it drop. We're not going to interfere. We're going to let the fundamentals determine exchange rates. Well, if the fundamentals determine the dollar's exchange rate, it's going a lot lower, and it is not good news for Americans.
Peter, always great to speak with you.
Yeah, well, you know, QE2 is certainly going to weaken the dollar, but more importantly, it's going to weaken the U.S. economy. You know, we can never have a recovery while the Fed is doing QE. You know, any jobs that are created or any economic growth that is generated by QE2 will evaporate as soon as they stop doing it. So when they stop, then we're going to be in worse shape than we were before they began, and now they're going to be forced to do QE3, and the more they do it, the bigger problem they end up creating. The best way to allow the economy to recover is for the Fed and the government to get out of the way and let the market function.
First of all, Peter, I like a man who's got a lot to talk about, starts right out of the gates with what he wants to say. Got to commend you for that. But I do want to ask you about today's jobs report. I mean, doesn't it show that perhaps there is life in this economy and that this, you know, QE2 could just be a stopgap measure until the economy actually improves? We're seeing signs of it.
We created the wrong kinds of jobs. We lost manufacturing jobs. We need to create manufacturing jobs. So the service sector jobs that we created are just going to result in a bigger trade deficit because we're creating consumers, but we're not creating producers. We are adding to our imbalances. If the government got out of the way, then we would be losing service sector jobs and creating manufacturing jobs. That would be progress. What we're doing now is digging ourselves into a deeper ditch.
But in terms of the stock market and the economy are different animals. The stock market's rising on QE2, rising even on the possibility of QE3 because the dollar's going to weaken. And right now there's a very strong inverse correlation between the dollar and stocks. So if you think the dollar's going to go down more, that doesn't necessarily spell trouble for the stock market.
But it doesn't make you richer. You see, when the government does QE2, everything goes up. It's not just stocks that are going up. Oil's going up, food's going up, gold's going up. The dollar is losing value. So even as the stock market has a higher dollar value, people that own stocks aren't any richer because when they sell those stocks or they cash in their dividends, then they go and buy food or buy gasoline. It's going to be more expensive. So it's all an illusion created by the Fed.
Hey, Peter, I'm going to get to Brad in a second. But Peter, I remember this. It was, we're going to create jobs. Stimulus, signed it away February 2 years ago, create jobs. And all of a sudden they realized that there was no way to quantify that. And they said, oh, wait a minute, did we say we meant create and save jobs? Here we are. 7 million jobs lost since Obama took office. Yet today we hear they created 900,000 jobs. Where?
Well, you remember, the government can create jobs, but they can't create purchasing power. Remember, in the Soviet Union, everybody had a job, but you waited online 8 hours to buy bread. You know, you mentioned earlier that if you were afraid President Obama is going to try to take credit for the economy. Don't worry about that. In 2012, the economy is going to be much worse than it is today, and the president's going to be trying to blame the weakening economy on the Republicans in Congress. That's what's going to happen.
I really don't. I'll go out there and on a limb and say I think it's going to be vastly better in 2012, and I think it's simply because the consumer hasn't spent, and eventually it feels like that boat is turning. Brad,
the consumer is broke, and the fact that he's spending now is part of the problem. We're digging ourselves into a deeper hole.
Consumer's always been broke, Peter. You and I both know that. With the American consumer's been
He's never
broke
been this broke,
years.
and the government is broke too.
No doubt. All right, go ahead, Brad. Wait a minute.
Look, barring some sort of unforeseen event, the law of cycles dictates that the economy will probably do better in the next 2 years. But then Obama's faced with a very difficult decision because in 2012, the tax cuts that he lobbied for against his far-left base are going to expire. Now, people will say, hey, those tax cuts helped get us to where we are today. What's he going to do? Is he going to go, okay, is he going to go out there and say, okay, now it's time to raise taxes again? He's going to be facing the exact same debate that he had now, but now not on an off-season election, now on a presidential election.
Well,
and he's in trouble.
Don't be so sure that the
conundrum
economy is going to be. What if interest rates move up dramatically? What if oil prices are $150, $200 a barrel? Why would the economy be better?
Oh, because Peter, the only way oil moves up to $200 a barrel is because the economy is better.
No.
What
if it's because the dollar's losing value? What if it's inflation?
The last time oil was $147 is when we were hitting on all cylinders.
No, we weren't.
in the
We were a
economy.
bubble. We weren't hitting on any cylinders. It was a bubble about to burst. The
But
only
we live
reason
on
that oil
bubbles.
fell.
That's what the American economy is. It's one bubble to the next bubble. It was an
Yeah,
internet bubble
we're-
that became a real estate
we're
bubble.
We're out of bubbles.
Perhaps. Go ahead.
Well, the economy's been so low, it has nowhere to go but up. But I would say
No,
this.
it's not. It's got a long way to go down.
If I was basing everything on the Bush administration, I'd have to agree with you guys and say the government doesn't create jobs. But if I base it on the Clinton administration, I'd say the government can create 20, 25 million jobs.
It
in 8
can
years.
create
Hold
miserable
on,
jobs when
guys.
you have nothing to show for it.
This is important, Peter. What happens if Obama now gets 2 years of pushing back the tax rates and does what he says he's going to do, starts looking at the deficit, looking at the debt starting next year, and that starts to come down? I mean, boy, that could be pretty powerful
The debt's not coming down. The debt's going up. What are you talking about?
I'm saying if he attacks it, if he goes after it. I mean, there are ways to do that.
Well, how's he going to go after it? He's going to have to cut spending. He's not cutting anything.
Bingo.
They're ignoring the deficit.
Right.
So this is a multi-layered discussion. Let's first start out with the underlying premise that Meredith Whitney has, which she says we've got a muni meltdown coming, that these guys are not, the states aren't going to be able to pay their bills. Peter Schiff, is she right?
Well, I saw that 60 Minutes program. I think she's sugarcoating it. You know, I've been telling my clients to sell their municipal bonds for years because I could see this train wreck coming from a mile away. I mean, the problem is you had all these states and local governments that made all sorts of promises, particularly to their employees, in terms of pension benefits, health care benefits. They borrowed a lot of money in the process. The bills are coming due. The taxpayers can't afford to pay. They either have to default on their promises or default on their debts. And the worst possible scenario is that the government bails them out.
We're going to get to that, but hold on. That's the second layer discussion. But Don Leskin, do you agree with the underlying premise? Are we at some point here where we've just got a crisis when it comes to municipal bonds across the United States?
Well, look, I didn't hear Meredith Whitney or Warren Buffett use the word meltdown, use the word crisis. You know, really, let's all get a grip on this. We know that there are all kinds of financial stresses throughout this economy and throughout all the developed economies in the world. The good news is that we're coming out of a very deep recession, and recoveries are like a wonderful medicine that makes all problems at least a little bit smaller. All right? So, look, whatever is going to happen, I mean, I happen to be talking to you from California, which is always said to be the Greece of the United States. This is supposed to be where all the problems are. And in case you haven't noticed, the lights are actually on. Okay?
So if I understand you, Don, you're making the point that, okay, there can be a lot of defaults, but it's not necessarily a systemic crisis that brings us all to our knees.
Yeah, why should it be? Right.
Peter Schiff, okay, so it's going to be bad. You shouldn't own the muni bonds, but is it going to lead to the debilitating 2008, you know, everything's on fire situation, or is it just going to be a round of defaults and we're going to get over it?
I think the municipal problem is part of the larger crisis that is coming, because as interest rates rise, it's not only going to be the states that can't pay, but the federal government that can't pay, and more pressure is going to be put on the Federal Reserve to be the buyer of only resort to continue to print money, but not only to buy treasuries, but to now buy municipal bonds to prevent them from having to default.
Ben Bernanke's going to be buying Harrisburg's water? That's what you're telling me?
They're going to start buying everything and printing money to do it. And that's, you know, you're going to see more increases in commodity prices, food prices.
Peter. Exceptionally low for an extended period.
Yeah,
Where you been, man? I mean, that's been the quote from the Fed for the last several months.
That's what they're saying. But as consumer prices really start to move higher, as the dollar starts to tank, as long-term interest rates start to spike, can the Fed really maintain that posture?
Hey, Peter, if we have these higher rates and we have an economy that at least is chugging along, why would the dollar fall apart? If I look around the world, I want to buy dollars. I get a higher rate.
No, the dollar, look, if you throw out the euro.
We had $600 billion of QE come in, and the dollar went up.
No, it went down. You're looking at the euro. I mean, Europe has problems too.
I'm looking at the U.S. dollar went up since QE.
Look, this Australian dollar was up 16% this year. The yen was up 13%. The Swiss franc was up 12%. Gold was up 27%. Silver was up 75%. How do you see the dollar going up? The dollar went down.
Since QE2, the dollar has gone up. You're mentioning those things from the beginning of the year. Yes, it has. Look at the Dixie. Look at the dollar index, which, of course, is versus the euro. Look at that. The dollar has gone up. The interest rate differentials are changing, particularly with Europe. If you look at the euro 2-year rate versus the dollar 2-year rates, it's the smallest spread we've seen all year. Things are changing. They don't always have to stay the same.
Let me get Weiss into this discussion. If this was a hockey game, we'll call him the third man in.
The CRB,
I don't want a fighting
the
penalty
CRB closed the year at a 2-year high.
Peter, let me ask you this. In terms of, I don't know how you don't see the euro going lower and the dollar at least holding on or moving higher.
Who cares about
the price? Because we're an export economy right now.
We're an export economy. We're running a huge trade deficit.
We're running a huge trade deficit with China. In terms of the dollar, though, let me just finish. In terms of the dollar, though, that's where I'd want to be if I were a global investor. You need China to bail out Spain. You need China to bail out, to come to help bail out Europe. The Germans are getting tired of doing it. The French are getting tired of doing it. You know, UK, they've got their own issues. So you want to buy dollars, not euros.
No, remember, if China tries to bail out Europe by buying euros and buying European bonds, they're going to sell dollars to do it. They can't prop us both. They have to make a choice.
They've got a big surplus. They can do what they like.
Or they want to prop up the U.S. I think they're going to choose Europe and let the U.S. tank.
I don't see that. We're their biggest trading partner.
Well, Peter Schiff, with all due respect, has an argument that's fundamentally wrong right now. He, like many people, asserts that the increase in the money supply is what's driving the increase in commodity prices. However, if you take a look at the money supply, the trend line going back from the start of the decade until the day before Lehman collapsed, we are effectively, at this moment, right where we should have been had September 2008 not happened. So while the money supply might not be going up fast enough for you, it doesn't change the fact that the money supply is exactly where it should be. The Fed has not expanded the money supply.
Sure. Where do you think it's getting all the money to buy all these bonds?
The money supply is going up, is exactly the point that it is at, is exactly where it would have been had the pre-Lehman trend continued.
Well, sure, and the pre-Lehman trend was inflationary. You remember where commodity prices were in 2008? They're still lower than they were then. They were going off the charts. Oil was $150 a barrel. Some of the commodity prices were a lot higher than they are right now because all the inflation that the Fed was creating prior to that. But here's the big difference right now. We've been exporting our inflation all around the world, particularly to countries like China. They are choking on it right now. Prices are rising rapidly. They have had enough.
And what they have to do, rising rapidly.
In China, sure they are. Take a look. And also in Latin America. And what the Chinese are going to realize is that they have to stop importing our inflation. They're going to let their currency rise sharply. That will bring prices down in China, and that will send them soaring here in the United States.
Their currency should rise, Peter.
Yes.
Their currency should rise.
And when their currency rises, our currency is falling. So prices are falling for the Chinese, and they're going to be rising for us. And when the Chinese stop buying our paper, they also stop buying our treasuries. So interest rates rise, commodity prices, consumer prices rise, and then the Fed's going to be in a real box because it's going to have to get very aggressive on interest rates when the recession is worsening. The Fed doesn't really care about the actual rate of inflation. The Fed is trying to use these phony government numbers as cover to keep creating inflation, which is what the Fed wants to do because it wants to bail out the politicians in Washington who want to keep on deficit spending.
Well,
if we had any central banker with integrity, he would be raising interest rates and forcing the government to cut spending because we're never going to have a recovery. What we're doing now is we're spending more borrowed money, and as we're spending ourselves deeper into debt, we're pretending the economy is growing. It's not. We can't really grow the economy until we shrink the government.
Peter, nowhere in the Fed's mandate is it required to facilitate or prevent government spending. I agree with you that there's a problem on the fiscal side of things, but it's not the Fed's job to get in the way of that.
Well, no, yes, it is. I mean, the reason we have an independent central bank instead of the Federal Reserve being an arm of the Treasury is so the politicians can't have their debt monetized. They're supposed to take the punch bowl away. They should be tightening. They shouldn't be worrying about the fiscal about the consequences.
Peter, let me ask you. It's interesting.
Wait, let me just quickly add one more quick thing, Larry. We quote unquote tightened in the summer and the fall of 2008 when this same I feel the feeling I forgot from that time because the CRB was going straight up, oil was at 140, and the Fed paused, and the second half of 2008 was atrocious in part because the Fed tightened implicitly.
No, it was atrocious because the Fed was too easy in the years leading up to it.
The falling commodity prices tells us the Fed was not loose enough.
No, they were too loose from 2001 all the way to 2007. It was that cheap money that inflated that housing bubble. It's the reason that everything went up.
Just the last one.
Look, the Fed shouldn't have given up.